Okay, traders, we'll look at gold now. I forgot to cover it in the prior video, but it went on a bit. So the prior video, fair bit of education and explaining in that. It's quite a long video in that oil video, which was a trade setup that was taken and illustrated to everyone in the Discord group today. Um, Now, with gold, I'll just speed along with gold, really. We had two scenarios. We had the breakout of these are all drawings that I was doing in anticipation of the opening range, which is this box of New York. And I was giving a bullish scenario and a bearish scenario for the day ahead, assuming that we wouldn't just go sideways, right? So, so this is the outcome. We got a breakdown of the opening range box. Let's rewind to roughly when I was doing the analysis. It would have been somewhere within the London session, 9 a.m. Okay, and we're on a 15-minute chart here. So we were looking at a context where the market had a fake out high of Monday's range. Okay, so it broke out of Monday's high and pulled back in. So is that bearish or is that bullish? Well, bearish. Okay, bearish. We've got a bearish trend in play. All right, so that's the first thing that we're looking at. We're also looking at how is the day set up. So on the day itself, we've got prospects of sort of a inverse head and shoulders. So you've got this impulse and a correction. So yeah, so we're looking at the impulse, the correction, and a continuation. All right, so that's bullish. Just get rid of all these drawings. So a bullish prospect, impulse, correction, continuation. Right, because on a multi-time frame basis, we've broken down Friday's lows. The stops above Friday's highs. We talked about this in the watch list video if you want to go and look at that. So impulse correction continuation to target liquidity above Friday's highs, while being in Thursday's sort of value area. And what we needed to do is get outside of Friday's value area high because we're above Monday's value area. So we're in breakout, and therefore, if we can just get above that level, I think I had that drawn a second ago. If we get above that, then we're looking for a continuation out. So there's two ways to play it. You either play it from inside of Asia's lows in here, in anticipation, as we get inside of Friday's value area. So we're taking it on the inside of Friday's value area low, as well as the Asian low. So that would be the sort of optimal area to get in. And then you've got the risk of resistance at the closing price of Monday, combined with the value area high of Friday. So you want to start thinking about taking profits, exiting, can't say that properly, exiting here. So you've got sort of a day trade into that area of resistance. So that'd be one way to play that. So that would be prospects of a scalp day trade up into here as potential resistance, but holding on with anticipation that this breaks out and we get an extension of that correction up into a minus 272, right, targeting the previous week's high. You know, can it realistically move that far in one day? Potentially. We can use the ATR as a guide. I've got that here as an indicator. So about $55 it's moving on average per day. So that would take us nicely into the previous week's high, $47. Okay, so that's one prospect thesis, right? And you've got this sort of head and shoulders on the day template. And if you look at this, this is, and the market is fractal. So you've got left-hand shoulder, here's the head. And you got, it's red just because I've got it on red for the moment. And then head and shoulders extension. So looking for the breakout. So it would be something like a break of the neckline, if you like. So up in here for a continuation. Okay, so that's thesis one. And I just want to show that that's fractal. So we've got that pattern on the daily chart. Look in here as well. That would be a similar scenario. Left-hand shoulder, head, right-hand shoulder, breaking up. So impulse through here, neckline being yesterday's highs for a continuation prospect. And where, sorry, I sort of skipped the gun a bit. So getting in here at an optimal level down here, or on the breakout of the closing price. If you're worried about that closing price and the highs of London, or even the highs of yesterday, if you're concerned about all of that being a resistance and you want to be more conservative, then you're waiting for the price to do its thing, and then you're taking it on the outside over here as a setup instead. So that would be your either a secondary entry or a full entry, being patient and waiting for the market to confirm your thesis on the outside of the schematic. So that was that. However, I also gave a bearish scenario, and the bearish scenario is in the context that we've got a fake out high and we don't want to trade into that fake out high potentially. That daily resistance. Okay, so as you can see, fake out high. And instead, what we're going to do is assume that that's the high of the week at the moment, the current week. And we're not coming up for stops above Friday's highs. And instead, what we're going to do is we're going to come back into the value area of yesterday. All right, so we're already below the value area low of Friday. And then what we're looking for is a breakdown of the box. And that's the opening range breakout strategy, which I've talked about and posted in the Trend Predator channel on Discord. All right, so we're just taking the breakout. And at this point, what we're looking at are the candles. So I've got an indicator that helps us align with fake outs and so on. So breakdown candles, etc. So here on the 15-minute chart, we've got this beautiful fake out high. Okay, you've got a fake out low, then a fake out high that then breaks down the London low, and the thesis, instead of it being a head and shoulders to the upside, it's just 3 levels of drop, 3 sessions. Session 1, Asia, fake out high session. Session 2 was a breakdown session of Asia's low, and then we just assume the continuation, the trend. We trade with the trend. So when we break out of the opening range lows, then we just take that, right? And so at this point here, anyway, you're on a 5-minute chart. So you've got confirmation on that 50-minute chart that we're bearish. And then you're looking at these candles here. You've got this nice little sort of accumulation of a bearish hammer. Okay, and then you're just taking that bearish hammer signal candle with this breakdown candle, forming breakdown candle. You could even be prudent, just wait for that to close, which is something that I would advocate. Put your stop above the high. It's either going to go or it isn't, right? And you're targeting 3 to 1, 2 to 1, whatever it might be, levels. There's the previous day low as a target. Okay, the thesis is there are stops around that level, okay, because we've broken up, and traders that are long are vulnerable if they're just holding on in anticipation of that thesis number 1 that we talked about. So if they're holding on, previous day low stops, 200% range expansion of the opening range is also a candidate. So depending on how you want to manage your risk and your targets and your trade, set and forget or take out profits as you go or add would be something I'd advocate if you're skillful enough, confident about your setup. And it gets down to the previous low, and it just about gets to the 200% range expansion for a 5 to 1. Okay. So a shorter video, and I hope that is helpful.